Good morning. I'd like to call the August 8th, 2022 Oklahoma City Post-Employment Benefits Trust meeting to order. I'll look at item number 2 is approval of the May 9th, 22 minutes. Motion and a second. All in favor, cast your vote.
Trying to figure out how to get the poll up. Yeah. Okay. Yes.
And the motion passes unanimously. Item 3 is a presentation of the investment performance review for the period ending June 30, 2022. Mr. Anderson.
Good morning, everyone. Thank you. And I just roll through the pages. Okay. Before we go into the first few pages here, this is going to be a rough one. This is a difficult period of time for the first half of the year this year. In some ways, we should expect to have difficult periods of time like this, but this is one that's sort of unusually poor results given what's gone on in the markets. The first slide here is something that our firm is very proud of. We recently won an award with Greenwich Coalition, which is a rating agency, if you would, of financial service providers like ourselves. We are now a quality leader for the first year. This first year we really tried to work on the award as a firm, and we're very pleased. So we are a quality award leader of mid-size investment consultants, which is where I want to work, and hopefully that's the type of organization that serves this organization best. So you can see the criteria here. I won't read those all to you, but hopefully some of those ring true to what we have worked together with since, Laura, when do we start working together here? 2008. I think you're right. Now, we started investing in 2009, but that was the period. So hopefully these ring. Say again? Yeah. Well, if there's anything that history repeats itself, I think we're doing the same. So that's it. Hopefully this is something that's useful. And again, this is done with actual client interviews, and maybe sometime in the future, some of you will be asked to do this. And if you would, that would be fantastic. Next slide, please. Here we go, market environment. If we go into the next slide here, lots of bad things happened in the first half of this year. Of course, we started the year with inflation. We moved quickly on in the end of February to the invasion. We've had high oil prices, inflation ticking even higher, and a general shock in the markets, including oil and food, and what I'm terming the back to basics market of 2022. We're no longer looking at the big technology firms out there as the most attractive investments. We're looking at more mundane things like food, fertilizer, power generation, et cetera. The nice thing about this is U.S. dollar stands strong. U.S. economy is pretty stable through here. It's a little choppy right now, but if you think about that the Federal Reserve thinks inflation is the big problem, that's going to be driving markets for the foreseeable future. We've got another Federal Reserve meeting coming up soon. Will they raise short-term interest rates by 75 basis points, 50 basis points, or 100 basis points? That's to be seen, but it's fairly confident in saying that they will be raising interest rates to fight inflation. Now, the bad part about that is that mortgage rates go up. That's what we all see probably primarily. You could get a mortgage earlier this year for about 3%, and now we're high fives down from the sixes. So if you, like me, look at your housing valuation on one of these online services like Zillow, last year you probably saw a pretty decent uptick. In the last few weeks, you've probably seen it come off a little bit. So what they are trying to make the world do is spend less money, have less demand for goods, and that way inflation will hopefully moderate from about 8% earlier this year, which I can't remember 8% over the course of my career seeing ever. but that does have an impact, and it disproportionately impacts lower income folks. So it is a regressive tax in the worst possible way. So let's go on here. I'm going to go through the next few slides just to show you what performance is. So for the quarter is the upper right-hand side here. S&P was down 16%. And most of that was in June. You have Russell 1000, 3000, those are large cap stocks, down 16.7. Mid caps down 16.8, and Russell 2000 down 17. International equity also down pretty substantially. You'll notice that the EFA is down worse, so that's developed markets, so that's Europe, Japan. Outside of the US, down 14.5. Emerging markets down 11.4. One of the big reasons that you see this dispersion is that emerging markets tend to be commodity exporters, right? So talking about energy, food, cement, et cetera, that's a good place to be, right? It's a lot like Oklahoma. We produce food, we produce oil and natural gas. It's a great time to be an energy and a commodity exporter because inflation benefits you. However, Europe, as we know, are on the whole net commodity importers, meaning that they're having to buy natural gas from sources than they otherwise thought they would be right now, which is boosting prices significantly, also food, et cetera. One of the interesting things that I've been watching is natural gas prices, right? Oklahoma, Texas, America is natural gas rich, right? Natural gas prices here have gone from below $4 at the beginning of the year to above $8 for the MCF, which is the unit that it's traded in. So we've gone from 4 to 8. Great for Oklahoma, not so great for other folks. In Europe, that same unit of natural gas is selling for about $60, right? 8 here, 60 there, and they can't get enough. Firewood is being hoarded in parts of Europe right now because they're likely to be very short of gas to power. They can't restart the coal plants in time. And they're talking about rationing industrial use of electricity in large parts of Germany just so you can keep people warm over the wintertime. So, is there an opportunity in there? Yeah, I believe that there is for an investor. And you don't have to be mean-spirited to do that. So you see U.S. equities, non-U.S. equities, but really the kicker, the thing that's been so difficult this year for our portfolios has been fixed income, bonds. Interest rates go up, bond prices go down. That's what we see right here. So the aggregate bond index down 4.7, government's down 3.7. And again, this is the part of the portfolio that normally stabilizes when the equity market goes down. At least it has since about 96% of the time. So this is a highly unusual period that we're seeing here, that interest rates are going up. At the same time, stocks are going down. And that's been sort of the double whammy that hit the portfolio. What's the name of the song? Nowhere to run, nowhere to hide. That's really what the first and second quarters of this year have felt like. You can see the one-year performance here. Really wide dispersion here between the S&P, large cap stocks, and the Russell 2000. Risk off is what that means. Over this period of time, you also see that emerging markets, which is the riskiest of the risky equity assets, is down 25%. Again, that's mostly China. A little bit of Russia, but mostly China and Taiwan. And then you see that bonds are off. This is, again, a 99th percentile worst year for fixed income. Now, fixed income prices have gone down in the past. That means the yields are up right now, so our going forward yields look much better than they have in decades. Next slide, please. This is growth versus value. You'll see during the quarter, growth stocks traded off a lot more than value. So that means oil companies, banks, insurance companies did much better than high tech and consumer discretionary. And then if you look over the last year, that performance is largely the same, where value is performing much better. Next slide, please. This is one slide that will sort of stand by its own for a long time, I think. This is the Russell 1000 at the top chart, the Russell 2000. So large caps, small caps. And what this shows you is the performance of the individual sectors of those indexes over the past quarter, which is the darker of the two columns in each set, and over the last year, which is the lighter of the two. And you'll see as it goes down the list from communication services, consumer discretionary, the parentheses to the right-hand side of each of those group labels is how much of the index each of those sectors are. So you'll look down this list on the Russell 1000. Again, there over the last quarter, everything was negative. Even energy was negative over the quarter. If you look over the last year for the Russell 1000, there were 4 sectors that were positive, energy being the most predominant one at 40%. Now that sector was less than 3% last year. It's over 4% now, so energy is coming back and becoming a bigger and bigger part of the index. If you look beyond that, utilities, 13%, consumer staples, 5.3, and healthcare at 0.4. These are basically the things we cannot do without, right? Again, back to basics. You look at a similar pattern on the Russell 2000, which are small cap stocks, but the difference there is that we only had 2 sectors positive, again, energy and utilities. Only 2 positive returns for the last year. Next slide, please. Here are the biggest names here. Apple down 21% on the upper left-hand side. Microsoft down 16, Amazon down 34. Alphabet is Google down 21, and Tesla down 37. So those are pretty dramatic declines there. If you look at the top 10 performers, we have a bargain outlet holding, we have H&R Block, we have healthcare, United Therapeutics, you have consumer staples, Pilgrim Pride, grocery outlet, and most of those are plays on consumers buying less expensive food and goods for themselves. So again, that's really what we're seeing here. And again, top 10 worst performing, Carvana, sort of looks like a Ponzi scheme almost right now, the way that their accounting has been run up to this point. And again, when we have what I call recessions or difficult economic environments, this sort of thing is often exposed. Next slide, please. Europe, or this is international, you can see pretty bad across the board. Negative results for the quarter and for the year, negative results in US dollar and in local currency. You'll notice the US dollar return is the darker of the 2 columns in each pair. You notice how that's worse? It's because the US dollar is very strong right now. In a time of economic tumult right now that we're in, US dollar is looked at as a reserve and a safe currency. And so that makes the dollar go up versus other currencies, which has a negative impact on our non-dollar holdings. Next slide, please. One thing to point out here on the lower right-hand side, you can see that table that starts with China and then Taiwan. These are the emerging markets as far as Morgan Stanley Capital International classifies them. Notice that Russia is no longer in this index because they were eliminated immediately after the invasion as a statement that is no longer investable. One thing I do want to point out here is that some folks ask, well, is it time to invest in emerging markets? And I'm not a huge fan of that right now, but especially if you look at the top 2 holdings there, China and Taiwan, so it's 15% roughly of that index of the 30%. So they're 50% of the emerging markets index are in China and Taiwan, which is not a place that I feel great about putting new dollars today. Next slide, please. And then fixed income. Again, nowhere to run, nowhere to hide. Quality helped a little bit, but not a lot. And if you look over the last year, that 10.3% rate of return on the aggregate index is absolutely painful and awful. But again, yields are much higher now than they were a year ago. And so going forward, that will be helpful for us. Next, please. You can see spreads here. The interesting thing about this index is that, or the fixed income market, is that it sort of held in until April. And you can see that there were 2 legs that yield spreads blew out. So the yield curve is in the bottom. You can see how that moved higher. And then you had yield spreads moving higher, which is a double whammy again. So the interest rate underlying risk-free curve moved higher, and then any sort of risk premium out there was punished pretty hard during the first half of this year, but mostly in June. Next, please. This is it, the total fund rate of return, negative 13.5 for the last year. one of the worst we have seen. Next slide, please. This is sort of some changes and summary of the portfolio. We'll go to the next slide here. You can see that the return of the portfolio, we're still well above our net cash flow, right? We're proud to see that. You can see a pretty dramatic drop the first 2 quarters of this year. I did cheat, and I'm not trying to ruin anything here, but the market has recovered since June 30 somewhat. We are just under $90 million as of last week. So we've gone up from 84 to almost $90 million since then. One thing I like to point out here is that the total return, we go all the way back to October of 2009, Laura, there we are, 135% rate of return, which is dramatic. There's been some pretty rough times in between over this time period, and our discipline and our patience is really what drives our superior returns. If you look at the amount of income that is paid over that period of time, 165% of the initial allocation has been paid back in the form of income. That's without capital appreciation. So next slide, please. Asset allocation, not a lot of change right now, and we are not suggesting to change this right now. Next, please. Our allocation of assets is this. It's 62% domestic equity, 17% core fixed income, 10% international equity. I'm comfortable with 10%. I don't want to go to 20% international equity just because of issues there. Active duration fixed income at 7.5%. That's our tail hedge, or our tail risk hedge, which didn't work very well this year. And then we have high yield fixed income. So performance should, or next slide is going to be, next slide, please. Here is the impact that the first, or 1 quarter had, down $14 million. The equity portfolio was down 10.7. Normally we would expect some opposite move, but in this case, because rates were rising rapidly at 2.5. Loss on the fixed income portfolio. Not often that you see depreciation on all of these, and the Kavanaugh Hill cash fund decline, I think, is, I'm not 100% sure. I don't think that's down $13, but it could be. That's probably a fee. And here's performance. The last year has been very tough, 13.5%. The last 3 years, annualized at 5.46. The last 5 years, 6.78. And for the last 7 years, at 6.5%. The last year, our fixed income portfolio really hurt us, right? It's normally helpful. It's been helpful in many, many cases. The individual pieces generally work well, but that active duration portion by Hoisington has been very painful this year. It's been helpful, like I said. Now, looking down that list over the last year, you can see that our bond portfolio, Loomis sales, down 12%. Double line is our best relative performer, down 10.4, 25th percentile, but high yield really got hit hard in the most recent day. But then you see over Hoisington again is supposed to hedge equity market risk, but when equity market risk is caused by inflation, that's an unusual environment. Looking back over since inception on that manager, 18th percentile, outperformed its index even despite this, and this is a high volatility manager, usually not in this direction though. Our domestic equity portfolio, the S&P down 10.6 for the year, our mid-cap index fund down 16, which hurts, but they did exactly what it should. And then can't really call it a bright spot because it's a loss, but Hotchkiss and Wiley down 2%, 2.17 versus the index down 10, and that ranked in the 6th percentile. I thank you for your patience on this manager. They tend to be very out of phase with the rest of the market. You can see the entire U.S. equity portfolio is down 20%. I'm sorry, 13% for the last year. They're down less than 2 because they own energy. And they were one of the first folks to go into the energy market after the crack in 2015, 2016. And you can see over the last 3 years, performance has been quite strong, relative basis. Next, please. Stevens is our small cap portfolio. We don't like large losses, but you can see that they did outperform their index. And our international value portfolio, above median across the board and 15th percentile for the quarter. Again, not a lot of bright spots in the portfolio. Losses are painful. Losses are hopefully temporary. When you look at losses in the bond portfolio, that's going to be paid off over time, not amortized, but it's going to be paid off over time, and the fact that we're going to be collecting higher yields going forward. The equity portfolios, really, our index fund did exactly what our two index funds did exactly what they should. Our mid-cap value portfolio, we're pretty pleased with to see that. That portfolio did well, and I think that it's still selling for a remarkably cheap valuation, despite the fact that it's outperformed most of their peers, and expect that portfolio to do well going forward. And you can see that our small cap and our international value portfolio are better than their markets, but still, unfortunately, losses over the last year. I don't want to go too much more in depth on this, but I would like to cover, jump a few slides here. I want to go to, keep going. I want to go after this section that shows the individual managers here. Go back a little bit, please. So these are total returns, performance over time, cumulative. You can see that there are periods of time that Wasatch is the green line, that they do very, very much better than the rest of the market, and then they tend to trade off, which is an environment we're in right now. Page 42, please. And then here's our equity portfolio. Again, Causeway, international equity not doing well since 2012. This is our correlation slide. So this is 5 years. What we want to see is we want to see a few areas where we have negative correlations. This is correlation of monthly returns, right? So when everything is going up, we'd like to see something, or when everything is going down, we'd like to see something going up at the same time. And this would indicate that over the past 5 years, you have one asset, one portfolio, Hoisington, that does have a negative correlation with every other portfolio out there except for some of the bond portfolios. And that's been very helpful in equity market drawdowns. But again, inflation causes drawdown, which is going to impact bond prices. So I would like to see better results from them, but I do understand it. Page 44, in compliance. I'm going to recommend keeping all the managers in compliance where they are now. No downgrades, no material changes with any of these organizations. And next slide. This is our fees. This is a good statement. Our expense ratio of all of our investment managers, you can see them individually, total at the bottom. So that's an annual figure, 44 basis points management fee on all of these underlying portfolios. The category average for all of those would be 90. So we are better than 50% off when it comes to expenses for these funds. No compromise made for no compromise of quality for that lower cost. And I believe that's the final slide I'd like to cover. Yeah, that's it. I'm happy to answer any and all questions.
Any questions for Doug? All right, thank you, Doug. Now we'll move to item 4, which is receive the monthly investment flash reports for May 31st, June 30th, and July 31st, 2022.
Very well, thank you. Well, that was the bad news. If we could, May, we've already covered May, we've already covered June, so we'll jump right into July, which is pretty current. If we'll go into this to the next slide, you can see on the upper right-hand side, you can see markets recovering. And is it because of the Federal Reserve is acting with pretty stern resolve, raising interest rates more than we've seen in decades? That could be the case. And also, second quarter corporate earnings in the U.S. have come out to be better than expected, so you'll see the month of July, this is the reason that we stay invested. Right, if we remember, volatility in prices tends to cluster. So you have really bad days, and those tend to be followed by very good days. So when we look at the month of July, the Russell 1000 was up 9%, 9.31. Russell 2000 was up 10.4. That international equity index, MSCI ACWI, was up 3.4. And even our bond indexes were positive, up 2.4 and 1.92. And so since the end of the quarter, in percentage terms, the equity market has recovered about 40% of the drawdown so far this year in a month and a half, month and a week. So that's pretty quick. If you'll see month-to-date returns here, everything's green. Even on the month-to-date for the fixed income, again, everything green. And when we look at the year-to-date through the end of July, everything's red except for energy, and utilities, but it's really hard to see the gain for utilities because it's 1/10 of what it was in energy. So energy up 45%. I always thought that the world was assigning too little terminal value to energy assets, traditional energy assets out there. And I think we're really seeing this play out in fairly quick time right now. So next slide is the return. Again, we had 89.8, so we're still really close to that right now. $1 million, 52 paid in. And then the next slide is performance. So for the month, we're up 6.9%. Year to date, we're still down 12.9%. And the trailing year, we're down 8.55. And remember, that was down 13.5 for the trailing 12 months if you go back to June. So that's a nice recovery there. If we look at the quarter return, bonds are up. You can see our high yield bond was our best performer during that month as risk spreads have moved in pretty quickly. Fidelity Index and the Vanguard Midcap spot on their benchmark. Hotchkiss, a nice month there at 8.15. And Stevenson, a really nice month at 10.28. Trailing 1 year returns out of all of our funds, we have one positive rate of return. And that is the one that a year ago we were probably thinking about getting rid of, Hotchkiss and Wiley. Again, it's a game of patience, and it's a game of discipline, and keeping them over all those many years has been very beneficial over the last one. And then our international equity positive for the month, but outperforming its benchmark for the quarter, or for the trailing year. And I believe that is all of the monthly update.
All right, any questions for Doug for the July report? With that, then I would entertain a motion to receive the monthly investment reports. Motion. Second, record your vote, please.
Okay, I'm not getting voting buttons.
Just switch back from present.
Yeah. Very. I should remember that.
And it passes unanimously. Item 5 is to ratify claims. I'll entertain a motion for that. A motion and a second. Let's record your vote. It passes unanimously. Now, item 6A, items for consideration. We have a renewal of agreement with Nyhart for actuarial services with an estimated cost of $21,000. It's retroactive back to July 1. Staff have anything they'd like to elaborate on that? No? Okay. It's just a standard, normal, routine thing. So I'd entertain a motion on this item. And it passes unanimously. We're down to item 7, reports, comments from trustees, staff, or interested parties.
I just want to comment how much I appreciate Doug reminding us to be patient. This is a hard time to be patient. And you're so right. The long outlook is what we need to take. Sometimes I worry that some of the observers might not be as experienced with this and see some scary minuses in there. And it's hard. It's hard to resist the urge to bolt into safer investments, but we know that better days are ahead. So thank you.
All right, seeing that we are at item number 8, we are adjourned at 10:29.